Hello everyone, and welcome to your Glassnode video report for week 36. I'm your host Checkmate, and we're recording this on the 7th of September 2021. This week we took a bit of a deep dive looking at some of the Bitcoin transaction volumes, and after we've seen such market strength, we've seen price obviously rally from that 30 to 40,000 consolidation range and really push up with tremendous strength over the last month. And what we're really going to be looking at is the transaction volumes and what it's telling us about the type of network participants, and particularly how that's changed since previous market cycles. So we compare it to what we looked at in 2019 in that previous market zone where it was generally smaller retail and early funds that were in this space. And what we're really seeing is a growth in the size of capital that's moving through the system. And even after a fairly substantial 50% correction, we've really seen the stickiness of that capital. We've seen these large size transactions tend to stick around within the space. So we're really looking at who are the different participants based on their transaction sizes. We also look at our miners. So we're going to have a bit of a deep dive on the mining revenue. So looking at their fiat versus their Bitcoin income and how that's really changed based on the change in hash rate, the change in miners coming on and off the network, as well as the change in price. We're also going to look at that institutional size capital, so the size of transactions, mean transaction sizes, and how that has changed over market cycles. We're going to look at the spending behavior between young and old coins to really understand what's going on in the current environment after seeing a very strong push higher in prices. Are we seeing the overall behavior of spending? And we're going to look at a new metric called the spent volume age bands, which really gives us an idea of how much of the coin volume that's being spent is relatively young or relatively old. So we can look at two different sides to it. How old are the transactions, which is our spent output age bands, or we can look at the age of the volume. So we actually take into account how much coin volume was transacted. And the last one that we're going to look at is a rising level of open interest in our futures markets. And this applies for both Bitcoin and Ethereum, where Bitcoin is approaching all-time highs, Ethereum open interest is at all-time highs. We also look at the funding rates to get a bit of a view on the directionality of this and whether there is a bit of high leverage and what that could mean as a bit of a headwind in the shorter term. So that's an overview of what we're going to look at this week. Let's jump across to Glassnode Studio and we'll get started with the analysis. So here we are in Glassnode Studio. We're looking at our week Onchain 36 dashboard. And what we can really see on our price chart for both Bitcoin and Ethereum is this continued price strength. We've really seen some very, very strong price performance. We noted in previous videos that we had a fairly strong amount of accumulation that occurred down in this $29,000 to $40,000 level. And we can really see that by the number of coins that moved back into profitability as the price rose from that level. So we understand that there was a large amount of accumulation that likely occurred down in this zone, and we've really seen that springboard of price from that level. So what we're going to start our analysis with is actually our mining front. So what we saw in around mid-May is we saw a very, very large proportion of the hash rate network come offline as there was a ban coming in through China, and we've essentially seen those miners have to turn off their rigs, start to go through the process of rehoming them, relocating their operations, and this just takes time. It's a logistical challenge to move all of that hardware. So what we saw is that on a 14-day median basis, so this kind of smooths out over the difficulty adjustment period and gives us a fairly realistic view of the total hash rate. We saw a decline from about 180 exahash down to half of that, about 90 exahash. So what we've really seen is this decline of about 50% of the hash power. That gives us an indication that roughly half the network was affected. And what we've since seen is a 42% recovery back to about 128 exahash. We've seen this recovery of hash rate, and this is positive. Now, it could be a combination of obsolete hardware that was previously no longer profitable because the hash rate has come down, the competition has fallen off the network. Some of those older rigs may in fact return to profitability. So some of those older rigs that were previously obsolete have to come back online, and it could also represent some of those affected miners in China actually rehoming their equipment, shipping them overseas, re-establishing elsewhere, but otherwise we're seeing hash power coming back online. Now, the other thing to note is when we look at our total miner revenue, now this is priced in USD rather than BTC. So as the halvings come along and more competition comes onto the network, we've historically seen, so if we ignore this great migration zone since May, historically hash rate has been in a up and to the right trend. It's essentially increased over a significant period of time, and this is despite the amount of coins that are issued by the protocol continuing to decline. So we've got more competition fighting over fewer and fewer coins with each halving. So what that ultimately means is that if you price how much BTC is earned per exahash, that's in a continual decline in BTC terms. Now, when we have 50% of our network come offline, even after a 42% recovery of that hash rate, the US dollar revenue, because of the increase in price, has actually spiked quite substantially. But simultaneously, we still have about 30% of the network offline. So you've got 30% fewer miners fighting over the same number of coins. And this is after we've seen price actually rebound quite substantially. So on a per hash basis, the amount of income that a miner would earn per hash, it's actually up at around $380,000 per exahash. Now, this level was actually last seen in July 2019. So we're going to jump across to the Workbench tool now. And this is where we can really start to see how this impact actually plays into it. So let's turn off our miner revenue per dollar. So what we have shown here is our price chart in black, and mapping onto the left axis, we've got our miner revenue per exahash, so on a per hash basis in BTC. And this is where we can see this continual decline. We get our halving, and then we have this long-term, more competition coming online, fighting over the same number of coins. So per hash, you're getting fewer and fewer BTC. We can here see where we get our increase. So it rises up from around 5 BTC per exahash up to around 9. So we're seeing almost a doubling. That reflects that 50% of the hash rate coming offline and then starting to revert back down to the downside. So overall, in a structural sense, we have a continuous decline in BTC earned per hash. But now if we look at that in US dollar terms, because we then have to factor in the variable of those coins may be declining, the amount of coins that a miner is earning is declining, but the value, the US dollar value of those coins obviously fluctuates with price. And note how where we are at the moment up here in this top section, as price has rallied, even as we have this competition coming back in, we've seen a 42% increase in competition, but we've also seen a more than 42%, it's about a 60-something% rise in price. Overall, that results in more US dollars earned per exahash. And we can actually see that even though half of the network is affected by this, the amount of revenue is similar to what we saw up here in the $50,000, $60,000 range, and is also similar to the pre-halving event that we saw in 2019, July 2019, when price was 14,000. So it shows you that 14,000 times double the amount of coins, even factoring in this increase in overall competition. So even though there's been more hash rate come online, even comparing from here to 2019, we still have miners earning a very, very hefty sum. So it's an extremely profitable venture at the moment when we factor in the US dollar income. So it just really shows that even though there's more competition coming online, even after we've had the great migration and the impact of the hash rate, we're still seeing miners be extremely profitable. And this is really what's driving some of that obsolete hardware to actually get a second lease in life and be able to come back to market and still be profitable despite newer hardware more or less making it obsolete in the grand scheme of things. Now, what we can also generally expect as a result of our miners having an increased amount of profitability is at some point, there's going to be a point where either the miners who are affected in China need to liquidate some of those coins to actually cover their costs because they still have logistical costs, capital debt levels, all of these things have to be paid for. And simultaneously, there are miners who may wish to be buying new equipment, expanding their operations, or just de-risking and taking some profit off the table. And what we've seen over the last month is that we've seen some of that miner spending. This is our unspent balance in miner wallets. So this is the amount that's been accumulated. You can see that overall miners have been accumulating throughout 2021, but over the last month, we've seen more or less a evening out. So all of the accumulation that occurred since around August onwards has essentially now been spent. As some of those miners are taking coins off the table, we can see our miner net position change has closed back down to neutral, but also note that this is well within the typical behavior. We saw a little bit more spending going on in January 2021, but other than that, we tend to see plus or minus 5,000 BTC per month as a typical spending or accumulation rate in green for miners. So it's not necessarily showing that there's a mass exit of miners. It's showing that some of them are de-risking, likely taking profits off the table, and perhaps even redeploying that capital to expand their operations or covering some of those costs. So it's just one of these interesting dynamics that we get to see play out on chain, and quite clearly the market has been able to absorb that sell side pressure. So it also tells us a bit of a story about the demand side, that there is enough demand to actually absorb those coins. So now we're going to move on and talk a little bit about institutional volumes and just the change in overall transactability and the size of these transactions that are moving through the network and how it really compares to the pre-bull phase. So we know that 2021 has really been characterized by the entry of institutional money. And we can really see this not only entering the market in 2021, but also sticking around even after a 50% correction that we saw in May. So what I want you to note is in 2019 through most of 2020, we're looking at our mean transfer volumes. This is the average amount of value that was transacted on a USD basis in any particular transaction set. So what we can see is there's this fairly stable baseline. Now note how the mean transaction volume, this is on a non-entity adjusted basis. So what is just otherwise pulled from the blockchain. We're seeing an average transaction size around $25,000, right? It fluctuates up and down, but it's roughly around that $25,000 level. Now in 2019 and 2020, we're talking about mostly retail and mostly early institutional funds. So crypto funds and the like, who are relatively early into the space. What we then saw on our entity adjusted basis is a transaction size somewhere around $6,000 to $8,000. So once we factor in our mean transaction sizes here will include things like exchanges moving value around, internal transfers, which tend to be larger, and that will bring up the average. When we do our entity adjustment, which really cleans up for all of the economically meaningful, it removes all those self-spends, we're at around the $6,000 to $8,000 level, which at a retail level and an early crypto fund level, an average transaction between $6,000 and $8,000 is about right. Now note that from October 2020, this is really when institutions started to step in. It's when MicroStrategy started making their earliest announcements. What we really saw is that the average transaction size, along with the bull market, of course, we're going to see more interest and institutional interest, really started to rise. And we reached a high of about $54,000 average transaction. And even after this 50% correction, we still note how much higher we are. We're still about 340% above this stable baseline, which you can see was stable for quite some time. So this really reflects the pre-bull behavior. And even though there's a lot of accumulation going on, this shows a changing of the guard somewhat. We're seeing a larger size of capital coming in, and this didn't revert all the way back down to our pre-bull zone. We've almost started to set up this new stable floor, which is substantially higher, between about $30,000 and $34,000. So we're seeing this larger size institutional capital stepping in. Now we can also see this when we break it down by transaction size. So what these color plots are showing on the left-hand side is the proportion of all the volume that's moving. That's more than $10 million worth. In the green is $1 to $10 million worth, 100,000 to $1 million, and stepping down till we get to our 0 to 1,000, 1,000 to 10,000. So the other way to think about this is these yellow to red colors is really what we're talking about, up to 100,000. So this is really capping out where retail level interest is going to be. Most of retail is going to be in the orange and the red, up to $10,000. We move into some of the fund size transactions or high net worth in the 100,000 realm. And once we start moving into the millions to tens of millions, we're talking about very, very large capital. Now note how the retail and the early fund volume, this up to $100,000, has been largely squeezed from somewhere around 40% of the total transaction volume, squeezed up to become somewhere between 10, 20, 15% of the overall volume. And that has been replaced by these very large $10 million plus transaction sizes. We can see this in the total volume as well. Note the expansion of these $10 million transactions. That's really expanded quite substantially since October 2020 and is now continuing to trade higher than where it was earlier than that. So this is showing a stickiness. We're seeing this institutional capital is definitely there. We can see it on chain, and we can also see that whilst there was a reduction during the actual sell-off itself, it has not returned back to its previous volume profile. And that suggests that a lot of that capital is actually stuck around, is still in the system. And whilst we have these low transaction counts at the moment, the mempool is still relatively empty. The size of those transactions is actually quite large. So this is really demonstrating that flow of institutional capital, how it tends to be sticking around, and really showing that maturity of the space over time. So now we're going to step in and look at the spending behavior on chain. So the way to really think about this is the best metric that we have to understand who our cohorts of people on chain, because we don't track individuals, we look at the macro spending behavior. Time and lifespan is a really, really powerful tool. And this is based in the insight that the longer that a coin has remained dormant, the more likely it is to stay dormant. Once you get beyond about 6 months, once a coin has been stationary for 6 months, there's around a 2% chance that it's spent on any particular day, and that continues to decay with time. Whereas young coins, what I call hot coins, ones that are younger than a week, they typically have somewhere between a 30 and a 50% chance of being spent on any particular day. So a lot of the time, it's the same coins transacting amongst themselves. So what I'm really showing here, we've got our spent volume age bands, which classifies all of the transaction volume, whereas this chart is showing based on how large the transaction was in dollar terms. This is showing us what age brackets those coins were moving. So the yellow colors at the top here are what I call hot coins or young coins. They're less than a week, less than a day. As we move down into these purple colors, that's where we're talking about older coins, multiple years, multiple months, getting into the 5-year plus. Now, what's important is we want to see more of those younger coins on the move. And that tells us two things. What we're seeing at the moment, see this spike down in our light yellow color? This is showing that a larger proportion of the transaction volume is young. We also know that a larger proportion of it is relatively large size, $10 million plus. And that's telling us that older coins are staying dormant. The old coins that are being spent, they're not carrying a great deal of volume. So note here that our spent output age bands, and this differs from volume. This one considers the BTC volume, how old is the volume that's moving. This one is just looking at how old was the UTXOs that were spent. So it's more based on transaction count, whereas the one on the left is looking at coin volume. So we're seeing an increase in young coin volume, even though we've got an increase in older coins being spent. So that's saying that the older coins that are being spent are actually not spending a lot of coin volume. So that's the insight to take away here, is that even though we have more old transactions taking place, they're not carrying as much weight. There's not as much BTC held within them. They're relatively small compared to the younger coins. And we can actually see this in our revived supply metrics. So we've got 1 year, 2 year, and 3 year. What we're looking at is how many BTC that were older than 1 year, or older than 2 year, or older than 3 year came back to life. And what we're seeing is a decline. You can actually see there was a short spike as we rallied higher. Some of those older coins were revived, they were spent, they took profits, but now that trend is more or less reverting back to the downside. So we're seeing that overall, older coins are preferring to remain dormant. This is telling us that old hand conviction remains. There's more old holders who are willing to not spend, and they're actually going to sit on their hands. It's showing us that there's this inbuilt desire to hodl and increase conviction in the market. And when we're seeing an increase in these hot coins or these younger coins, the higher probability scenario is that some of those warmer coins are getting actually accumulated and purchased, and we're seeing our exchange outflows following suit on this. It's actually suggesting that there is more of an accumulation or a higher probability of accumulation than these older coins coming back to life. Now, obviously, if we saw this trend reverse, where we see these warmer colors, particularly in the volume bands, more of this old revived supply coming back online, that would say that maybe there's the inverse happening, where we're seeing more sell side by these older hands, more coins that were previously illiquid coming back into liquid circulation, and that would give us the opposite outcome, where we're saying that's actually going to be a bit of a headwind for price to climb through. And the last thing we want to close on, so whilst that overall supply dynamic is actually quite constructive, it's a fairly positive sign for prices. It's showing that old hand conviction does remain. There is another side to this market that we have to consider. So that's really the on-chain space. But then there is also the faster moving and highly leveraged side of the futures markets. Now, in the shorter term, futures markets can have a little bit more of an influence. The analogy here is that the spot markets and these, as we look at on-chain space, that's really the dog. And in many instances, the futures markets is the tail. Now, what can happen is if there's too much leverage, there's too many people trading in one direction, the tail can start to wag the dog. And this is what we saw in March during that sell-off. We essentially saw that the futures market had these cascading long liquidations. People had to exit their positions out of necessity, and one person's sell side became another person's stop loss, and the thing basically cascaded all the way down to 29,000. Now, what I want to highlight here, and again, none of this is assured to happen. This is just looking at the different scenarios and where potential risk could come into the market. And what we're seeing is that for Bitcoin, our open interest is not at an all-time high yet, but it's certainly approaching a similar level. So we're seeing a fairly large amount of contracts being opened in perpetual markets. Ethereum is actually now well and truly up above the all-time high. When the newsletter came out yesterday on Monday, this was actually more or less at the all-time high, and we've actually seen it continue to expand. So we've now eclipsed that by some margin. So it's showing that more and more leverage is coming into the system. But for every buy side, there's a sell side. So just having open interest doesn't necessarily say whether the market is highly long or highly short. This is where we then look to our funding rate. So this is the interest rate being paid by one side of that trade as the futures markets push further ahead or below of the spot pricing. Now, when we have these positive funding rates, so note that we have positive funding rate for Bitcoin and very quickly accelerating funding for Ethereum. Now, what that's suggesting is that people are willing to pay an interest rate from long side to short side in order to take on that leverage. So it's actually suggesting that there is more buy side, there are more people with an interest in being long, and that therefore means that their stop losses could be closer to the current price, and the increased probability that if we do happen to get some downside price action, particularly for Ethereum being at all-time highs, but it's present for Bitcoin as well, there is some of this higher leverage creeping in, and it is dominant towards the long side. So as part of our risk framework, whilst we certainly have strong conviction in the market, we're seeing in the on-chain space, it looks quite constructive, it's quite healthy. We do need to be aware that there are these shorter term risks, and it's possible that like March 15, there could be a phase where we get this liquidation or this movement of closing out these positions in the future space that can pose a shorter, or if it gets bad enough, a longer term headwind for prices. So it's really about just trying to understand the risk framework, how are these different markets interacting, and just noting that we do have a large amount of leverage, and it seems to be to the long side. It's not quite the same as what we saw back here in Q1 and Q2. We had extremely strong funding. It's not quite at that level, but it is accelerating, and Ethereum seems to actually have a lot more leverage to that side. So that really wraps up our view today. We've gone through the miners, we've looked at spending behavior, we've looked at overall institutional transaction flows, and then just assessed some of that risk in terms of the leverage markets and whether there is actually a headwind there for prices. So as always, thanks for tuning in. Really enjoy making these videos for you. Make sure to give us a comment, a review, and a subscribe, and I will see you next week. Cheers.